I want to get your reaction to that news out of China. We're seeing Chinese tech stocks and also some very popular ETFs that are related to China, Chinese equities falling. The K-Web is one that really caught my eye. Shares down just about 5% there.
I think conditions in China remain pretty tough right now. They're really struggling to get stimulus going. They're still struggling with post-COVID, restarting the economy there. And they've thrown a lot of money at the problem. None of it seems to be working so far.
All right, well, there you go. Again, shares of Alibaba down about 3.5%. PDD Holdings, Pinduoduo down 2 3/4, and then we're going to show some other stocks here. Quite a bit of stocks under pressure. I want to turn back to the United States. We saw record closes for the S&P and also the Dow. Actually, the Dow closed fractionally lower, but hit an intraday high. This is on the back of that quarter-point rate cut. We just showed the chart. S&P moving higher during the press conference when Jay Powell struck a very dovish tone. What did you make of the cuts and the impact on the markets going from now through the rest of the year?
Directionally, I think it was pretty well articulated that they're going to be on a pathway to continuing to lower interest rates. I actually think with the new administration, given how much a lot of it is very pro-growth policies, they may take a pause on that to make sure that inflation stays in check. Plus, it's yet to be determined how tariffs are going to impact, because that's been a cornerstone of the incoming administration's policies on how to deal with China. And perhaps some of what's going on in China is preemptive, anticipating that some of the things that might be done by the Trump administration might hurt a little bit.
Let's come back to the U.S. for a second. Yep. I know you're a big fan of small and mid caps. You call them SMID, a little Wall Street jargon there. Yesterday, we saw the Russell 2000 actually close lower. So this is election week. We obviously saw a big small cap rally on the back of the election, a so-called Trump trade. But we also saw the rate cuts. Now, this seems to be especially notable. The rate cuts are supposed to be, very a big tailwind for small caps because of their debt situation. And you're also looking at the valuation of small caps. So not valuation, EPS growth of small caps going into next year. EPS growth is supposed to be double the S&P. You're not the only person with that information, Dan. The whole street has it. So why are we seeing small caps trade lower yesterday?
Because most investors don't believe it yet. They look at the Russell as a short-term trade. We're arguing that this is a long-term secular relative outperformance to the S&P 500. This is the second longest period of underperformance of the Russell 2000 relative to the S&P since 1931. Yet today, Apple's market cap exceeds the total market value of the Russell 2000 index. You can get you get 2,000 stocks for one Apple. All
right, so I have to ask you, we got to get out of here in a second, Dan, but what changes this underperformance? If Fed rate cuts and a dovish tone from the Fed doesn't change it, if the the election of Trump doesn't change it, which is supposed to be a pro-growth agenda with more domestic production, which hypothetically would help these companies, what changes the underperformance?
Well, the small caps went through a period where they had to deal with a lot of COVID-related issues, supply chain issues, inflation. All these things impacted those companies a lot more than the Apples of the world and the biggest cap companies. That's all in the rearview mirror now. Demand is very solid, and as we go through earnings season, earnings have been quite good for the small and mid cap stocks.